Russia, India, China, spend equal or less than 2.5% of their GDP on healthcare. They look at our 18% that we spend on healthcare as beyond staggering, because in many cases we spend more money on sickness care in this country than they have as a whole economy per person. And they want, just as we want to learn from the EU and other countries with their financial problems and solve ours, they want to learn from what they consider our problem, which is the enormous amount we spend on healthcare. With that, let me get started, and let's run through what we're going to cover today. And this is particularly exciting because literally in the next few days, I always said to Rick when I started, we might get interrupted today by the Supreme Court decision. So the Supreme Court might actually rule as we're speaking, and I'm going to run through these all right now. So first, if you're looking at your slide, we're going to run quickly through the following 10 items and get to summary and Q&A so I can answer what you're most interested in. We're going to talk about how Americans get health insurance today, and that really comes with an understanding of how U.S. health insurance evolved. I'd say, why do I need so much history? You need history to understand the implementation of the United States Supreme Court in terms of their 4 options, as you see in number 9 here, and you need to know the history to explain it to clients. Because one way when you're sitting with a client or an employer sitting with an employee, and they go, why do we do that? And if you know the history, I believe you'll always remember why. You'll be able to explain it, and frankly, you'll be much better able to serve your client and adding to your expertise. I'm going to tailor this presentation assuming that everyone on the call is either in health benefits as a broker agent or is an employer and is the person at their company responsible for distributing health benefits to their employers, so their employees. So it's going to be fairly technical. We'll go quickly, but I will take any questions. And of course, our staff is available afterwards for email specific questions about you and your company. So we're going to talk about number 3, Medicare through HIPAA, those 5 things and what happens to them under health care reform. We're going to talk a lot about the Affordable Care Act, which we're right in the middle of in 2012. It had 4 years of phase-in, the big year being 2014. We're going to talk about defined contribution health benefits, where the world is shifting. This has been a very good week for my family. As many of you know I've worked with, I founded and was CEO for the first 5 years from 1999 to 2004 of Extend Health. Back then, people thought we were crazy building a business with a lot of capital in defined contribution health benefits. Extend Health, as you probably know, we had an IPO plan. We filed the OPO in January. You should read our S1 if you want a lot of details. And one customer, Towers Watson, who I know as Watson Wyatt or Towers Perrin, their new name, bought the whole company for $435 million all cash. So here in Utah, we had a very good payday with some people who worked very, very hard and I'm very proud of. Sold Extend Health for $435 million. And as I say, it should happen to all our businesses like that, but we're very excited about it. And Zane Benefits, where I'm calling you today from, is actually a spin-off of Extend Health. We left Extend Health, the group that's here now, in 2007 to do Zane Benefits. We're then going to talk about how Affordable Care Act, the economy, and the deficit, these 3 things combine to affect 2012 renewals. We're going to talk a little bit about CLASS, that's long-term care funding and what happened there, and whether that's a harbinger for health care. We're going to talk about private exchanges, and of course, mostly we're going to talk about and build all right up to number 9 here. Number 9 is the United States Supreme Court. There are really 4 options for the court. You, as a health benefits professional, should be able to tell your CEO if you work at a company or your client if you're an agent, any day now, the Supreme Court's going to rule. Here are the 4 options. Here's how we prepared for it. And that's really the goal of what we're all doing here. We're learning in real time how to prepare for any one of the 4 options of the Supreme Court. And of course, we will do a webinar as soon as possible once the Supreme Court rules. And the ruling is expected between, it could come today, but we're expecting it June 21 to the 25th, so no later than 25th. With that, let's get started. First, I want to put this in perspective. How do Americans get health insurance today in 2012? And look at these 5 numbers. Group is 145 million, including dependents. Personal policies have been the growth in the market. Up, it used to be called individual family policies. We now refer to them as personal. That's 40 million, up from 12 million. That may not seem like a lot, 12 to 40, but that's enormous growth in benefits plans that normally change very slowly over decades. Medicare, 47 million, Medicaid, 45 million. This is very key because what you're seeing here is that in Medicare and Medicaid, we're going to go back to the history, we already did the heavy lifting. The heavy lifting, the hard work in healthcare was who's going to cover the old people, because the old people, the more you spend on them at 70, 80, 90, the more you got to spend next year. Medicaid, Who's going to cover the very, very poor? There's no money. We as a nation, and I'm talking here very American, have solved that problem. Medicare and Medicaid work. They really work for poor and old people. As many people here, my mother was on Medicare the last 30 years of her life, and the system with all its quirks and stuff absolutely works. She was able to see doctors, and as you know, the system goes. The uninsured is an interesting number. I put down here 40 million, but I want to be honest and tell you it could be as low as 10, could be as high as 20. It's mostly undocumented workers. Most people really are. Only 10 million in my mind are legitimately uninsured. And by that I mean that's like a homeless person who averages on the street 18 days, and then he gets picked up and gets a home. And similarly, the uninsured are many turnover. 10 million are chronically uninsured, but a lot of them come in and out of the system as they do jobs or Medicaid or move between states. So, wait, here we go. Next. Sorry for the thing. So the history of modern health insurance starts post-World War II. Before World War II, there was very little employer involvement with your health care. And then if you had health care, you might get it at the job. They had a doctor at the workplace. There was local Blue Cross and Blue Shield organizations for insurance. One was doctors, one was hospitals. And it basically was catastrophic health insurance because, frankly, that's all people went to see a doctor for when they broke a leg or something happened. And it was individually or family driven. That changed after World War II. Why? During World War II, we had wage and price controls. It's important to remember that when Roosevelt was leading the nation during World War II, they were as fearful of inflation as they were of the Germans, because they saw the German Nazi rise to power as a directly came from German massive hyperinflation after World War I. So the government put in wage and price controls in 41 to 47, which was pretty unfair because a lot of the entrepreneurs could just raise their prices and they didn't have to raise their wages. And so people who were entrepreneurs got very rich during World War II, and the government had very strict wage and price controls on labor. What happened? What happened was labor was going to do a massive strike. AFL-CIO, then it was the CIO. It's a separate organization, 1945. And for not doing the strike, Roosevelt said, I'll let you have temporarily health benefits exempt from income taxes and exempt from wage and price controls. Labor said yes, and that temporary fix became permanent. And that fix is enormous because income taxes post-World War II were between 70 and 94% on rich people. That meant when you pay for someone's health care tax-free, you're giving him 7 to 8 times that in subsidy if they're a high-earning person. So continuing along, let's look at what health insurance is today. It's important to realize that health insurance is not, quote, insurance. Insurance is something catastrophic. You insure your house for fire every year. You don't expect to have a fire. In fact, you don't want a fire. You insure your car. You don't want a car accident. Not so with health insurance. Health insurance today is 10% access to a network that, frankly, you can't get to see that private network unless you join a health insurance provider. 2, prepaid services. 50% of the premium of health insurance is actually money you're just paying up front in 2012 to use in 2013. From your annual checkup to your monthly prescription bill. 40% of health insurance is actual insurance. It's what you don't expect to get against a medical expense that could be catastrophic. So remember, 60%, excuse me, Rick, can they see my mouse here? Yes. 60%, this access and prepaid services, is really just a funding mechanism for health insurance. It gives access and provides the cash. Post-World War II, we had 2 types of policies. Now keep in mind, Medicare and Medicaid didn't exist then. We'll get to that in a moment. But we had group and personal policies. A group policy was exactly what it sounds like. It's a group at a company everyone's familiar with. And the personal policies were for those people, quote, unlucky enough not to work for a group. And, of course, applicants from employers were healthier than the general population. Group coverage used to cost half the price of individual. Focus on this last line here. To join a group with an employer and insure 100 people, those 100 people would be twice as healthy or cost half the amount if I went down the street and found 100 people not working. And it just makes tremendous sense. Employers hire what kind of people? Healthy people. So somebody in an individual personal policy back then, before 1970, probably wasn't as healthy. It was a good reason they weren't working all the time. So group policies used to cost half the price of individual. And that's why older people keep thinking, oh, yeah, I want a group employer plan that will cover me the rest of my life. Of course, the big thing about this slide is in those days you got a job after World War II, you were expected to keep that job the rest of your life. So, of course, they would provide you health insurance. Whoops, this is the last piece. And group policies enjoyed enormous tax advantages over personal policies. This last point here, as I mentioned before, tax rates were 70 to 94% among high-paid executives. And so when they could get free health care, the employer gives them $1,000. It's like the employer gave them $7,000. The government gave them $6,000 of the $7,000. Personal policies. Personal policies, which really started to go and become normal and grow in 1970, where it became subject to medical underwriting. This is a very key point. It used to be you apply for health insurance just like applying for fire insurance. They look at your house, they give you a policy. Not so with health care. Health care, the 45 states, other than New Jersey, New York, Massachusetts, Rhode Island, and Maine, 45 states dropped guaranteed issue. Let's come back and think what that is. 45 states met in the legislature, and they said, right now in our state, anybody who wants health insurance can buy it, and here's the rate. It's based on their age if it's not community rated. Some states said you couldn't even discriminate against age or against sex, and everyone can have a policy. And think about this. From 2011, and really key in the 1990s, 5 state legislatures killed guaranteed issue. They said, we will no longer tell our carriers you must policy when they apply. Why did they do that? They did that because by killing guaranteed issue, the insurance premium dropped by 2/3. Let's say that again. A family might be paying in 1991 $10,000 a year for health insurance, guaranteed issue for a family of 5. And then in 1991, when they said we're going to drop guaranteed issue, the healthy 80% or 90% or whatever it was, could buy the same policy not for $10,000 but for $3,300. Complete inversion. And personal policies by 1990 or really by 2000s became much, much cheaper than group policies. But they were medically underwritten with the exception of the 5 states. And it's fascinating to look at New Jersey through Maine, and because those states are where we may be going with guaranteed issue when I get to the Supreme Court. Then personal coverage started to really take off from 2002, going from 12 million to 40 million. And I'd like to say that the companies I've been involved with, Extend Health was believed the first defined contribution. We're now Extend Health part of a major company, Towers Watson, and more important, Extend Health is a major player in the personal insurance market. And of course, Zane Benefits. Zane Benefits provides the software that provides Extend Health what they do for every company, for small employers and large employers. And Zane Benefits is strictly a software company allowing anyone effectively to be an Extend Health. Group and personal policies became guaranteed issue small group. Now a little slower here. Oops, let me get back to that slide. Among small employers, starting in 1991 and 93, small group policies became guaranteed issue within regulated medical rating bands. The healthy employees started leaving the group market for personal coverage because they go to work for a company, especially if they've been out of work. The company would say, aren't you lucky? You can join our plan. We're going to only take $400 a month from your salary. And the employee who's healthy said, why would I let you take $400 a month from my salary? I can buy the same policy from the same Blue Cross carrier for $200 a month, and I already own it. So you start to see what happened. Healthy employees started leaving the group market, leaving the people in the group market of skyrocket policies. And we saw things that sound bizarre when I described U.S. health insurance as I was last week in India, or 2 weeks ago I was in Brazil. And I described that your employees work for you in a company, you offer them health insurance, but no one gets unless at least 75% agree. And the employer pays 90%. And the Brazilian asked me, the Brazilian economist, why don't the employers pay less than 90% or 80% of the employee? Because no one would buy it. The policy terminates when you lose your job. And that's what's amazing when I sit in India or Russia. And they go, I don't get it. The guy has health insurance. He works for a company. If he gets sick or doesn't feel well, he can't go to work. When he can't go to work, they cancel his policy. Oh, no, we have COBRA for 18 months. And they think that's barbaric. Why would you buy insurance for your health if you get unhealthy, it cancels the policy? But that's what group policies really are today. And then, of course, what we're about to see is the federal tax advantages of group, which were massive, 2002 to 2009, extended to personal coverage. What we saw is that group coverage had a huge tax advantage in 1970 because effectively an employer, number one, could pay for a group off the books. Think about it. You're an employer. anything you do with that employee financially has got to be reported by the to the federal government, except the health care. You can give unlimited health care to your employees, and you don't even report it as income, and they don't report it as taxable income. Moreover, number two, employees with POP plans could add to what their employee covered to pay for their spouse, pay for their kids. And I'm going quickly here because I'm assuming everyone on this phone call is a health benefits professional. Then came the U.S. Treasury. And here again, I'm really proud of myself, my team, and the companies I founded. In 2002, the IRS issued an official statement saying you can use a health reimbursement arrangement to fund a personal policy. If your company doesn't have a group plan, you can buy an individual policy, your employer can pay for it, subject to quasi-group laws. And I lobbied very hard. I wrote books about this subject. I received an honorary doctorate as the founder of Health Savings Accounts, which was right at that time. And I'm very proud of the 2002 IRS rulings and the team that I got to work with to make personal policy premiums tax-free. And then, of course, it got better. In 2009, the IRS said not only can your employer pay tax-free for a personal policy, you, the employee, can add to that amount any amount you want. So if you work for a company that doesn't offer any plans, go buy your own and pay for it with pre-tax salary like you would with a POP plan if you had a group. If you work for a company that has already an HRA back from 2002, well, why not just add to it? So in effect, there's now tax parity to personal policies. We at Zane Benefits claim a lot of that credit. We were one of the soldiers that made this happen, and we work very closely with the government to protect our rights and your right, if you've got a personal policy, to be on a tax parity basis with companies with group policies. So let's summarize here. What we saw is the shift to defined contribution policies. Now let's take a moment and talk about what defined contribution was. When I went to work at Citibank in 1976, I had just graduated a degree in economics from Wharton School, and I worked at Citibank, and we were told that the Fortune 500, the lead customers of Citibank, and we were the largest bank in the world then, were effectively bankrupt, actuarially. I go, they're bankrupt? They said, yeah, AT&T, Ford, Western Union, that was a big company then. All these companies back in the 70s, if you look at what they have on their books as retirement obligations called defined benefit plans, and you look at the number of employees who retired, they are bankrupt. See what happened. Life expectancy was age 50 in 1950. Expectancy went to 80. That's great if you're a life insurance company. Nobody's dying and you got all this money in prepaid policies. But look what else that means. When life expectancy went from 50 to 90, companies like Citibank, and of course our clients, companies like AT&T, had promised their retirees a defined benefit pension plan. That meant that no matter what happens in inflation, we're going to increase your cost of living, so you're going to have a decent life till death. And of course, we thought you were going to die at 65 years old when you retired. And we thought everything else would continue to go up. And we called these defined benefit plans, they were really open-ended checkbooks that the companies had promised their employees. By 1990, we solved the problem. From 1970s to 1990, the retirement industry completely shifted to defined contribution plans. What's a defined contribution plan? It's a 401k. What's a 401k? You only get out what you put in, matched by your employer to some extent. You only get out of an IRA what you put into the IRA. That's a defined contribution. Your benefit is the defined contribution you and or your employer added, not open-ended. So we saw this shift in retirement to IRA 401k. I remember in the 1970s listening to a politician, and she said, it was actually, it must have been 1980. It was Ferraro running for vice president of the United States. And she said, people are too stupid to manage their own retirement. We need to take care of them. And I today always smile when I think of that. I know she's passed away, but I remember her comment because today 68 million Americans have a 401k, 50 million Americans have an IRA, and we're not that stupid. 130 million of us have opened a retirement account. Moving past that, I started 1999 Extend Health to shift from defined benefit to defined contribution health care with personal policies. The company, after I sold with my team 2/3 of the company to Steve Case's Revolution Health Group, and it went on, and it shifted to retirees. Why? It moved to defined contribution versus defined benefit among retirees. One, they were used to defined contribution. Two, retirees through Medicare Advantage or guaranteed issue. So Extend Health grew to a company that only last week sold for $435 million cash. And why were we so valuable? Because we handled retirees. Why were retirees so valuable? They were guaranteed issue policies under Medicare Advantage. We'll come back to that when we analyze the new Supreme Court ruling. 2002, I've already covered. The IRS issues its policies in IRA. 2006, HIPAA comes out. We'll cover HIPAA in a moment more. And it says that in 10 years, everybody in 10 years, everyone on individual policies, every state must have some solution for its uninsurables. HIPAA said in 1996 that starting in 2006, you must cover your uninsurable population, which has a huge impact for companies switching from defined benefit group plans to defined contribution individual plans. 2007, and really we founded Zane Benefits here in 2006, and as many of you have seen, and if you haven't, please read it, it's a very interesting 5-page cover story with my color photo on the front page of the Wall Street Journal in 2007. And that's when we were just expanding and just growing. We had a handful of employees. And I remember calling the editor-in-chief of the Wall Street Journal in 2007 and saying, you know me as an author, and I can't believe this, but I'm going to ask you not to run the story on Zane Benefits. He said, Mr. Pilzer, it's a complimentary story. Most people on the front page of the journal with their picture call me for reprints, not calling to kill the story. And I said, listen, we're not ready to serve clients yet. We didn't have our deal done with payroll companies, with the big carriers. Give me a year. And he said, Mr. Pilzer, who's the editor-in-chief for the Wall Street Journal, we don't run stories because you want them or don't want them. We run them by what people need to know. And the story we're running on the front page of the Wall Street Journal with your picture, that employers can now give their employees money to buy their own health insurance, is the biggest story I am telling the readers of the Wall Street Journal in America in my 5 years as editor-in-chief of the Wall Street Journal. And that's how big he thought it was in 2007. And it's moving slower, frankly, than I would like, but it's certainly moving our direction. In 2009, the IRS, as we described, allowed individual employees to use PRAs, that's our term, where they can take pre-tax salary like a POP plan to pay for their personal policies. And here's the biggie. The biggie, which we're getting to right now, is in 2014, personal policies become guaranteed issue. We should have added a period there. It wouldn't be technically correct, but personal policies become guaranteed issue, period. Right now, personal policies are sort of guaranteed issue because you got to be out of work for 6 months without a policy to get the federal subsidy, or you got to be in the state chart, the state risk pool. But it all becomes guaranteed issue in 2014 for everyone. And that's what's exploding defined contribution. Now, let's talk about pre-ACA legislation. What led up to the Affordable Care Act? ACA is the current name. I didn't change it. It changed a few times by the White House for what we call Health Care Reform 2010. Pre that legislation, we had 5 major pieces of legislation we all live under. All of them are affected by ACA, and now we're going to talk about these 5 and how ACA affects them. The first, of course, is Medicare. Medicare is something that I cannot tell you how proud I am of this country, because when I just come back from Brazil, where they spend 2.5%, and they're working really hard to cover a lot of poor people, or India, 2.2% of their GDP on health care. And what breaks families? When you get old, you get sick. And when you get old, you get sick, you have to decide between medical care, which keeps you alive, or death. And where's that money? The money that pays for you when you're old and sick and need to get better, the money that buys the hip replacement or fixes the broken leg comes directly from the education of your children. I mean, the families take care of their own. And you can imagine the strife that goes on in a family when they're making decisions about keeping grandma alive and kicking out granddaughter out of college. And they literally make this in every country, not in America. We have an amazing system, Medicare, that all you hear about is what's wrong with it. Well, put me on a TV show. I'll show you what's right with it. It works. It's got lots of problems. It's got $50 billion of direct fraud. We could go on and on. But it covers 47 million people, and as an American, you should be unbelievably proud of it. It's the envy of the world. Number 2, Medicaid. Medicaid has twice the problems of Medicaid. Poor people can't be prescribed non-generic drugs. They have to get name brand paid by the government with no deductible. But again, Medicaid does a really good job. And the reason I put Medicare and Medicaid first is when we talk about health care reform, it's important to remember that we've done the heavy lifting. When I drove to work today, and I don't have to drive far from my home to my office, I didn't see any poor people on the street saying, I'm dying, pay for my operation. Why? Because of Medicaid. Medicaid covers 92 million with Medicare of our old and poor that nobody else would insure. The system operates, the system works. It's got to be reformed and tweeted, but it's really worked already for, 47, 48 years. And now we're talking about it may go bankrupt in 10 or 20 years. And why are we talking about that? Because we're going to fix that so it won't go bankrupt. Third item, sorry, I gush when I get proud of being American. Medicare and Medicaid are two things Americans should be very, very, very proud of. And the point is that we've taken them out of the equation, so when we do health care reform, our most vulnerable and the ones who won't get insurance, frankly, old people, have been removed. ERISA was enacted in 1974, primarily to reform retirement pension reform. In those days, it was kind of interesting. At Citibank, we had a retirement plan, and we managed it, the same executives as Citibank managed it, but it was the employees' money. And every time we would gamble the money in the stock market, and we literally gambled our retirement plan when I worked at Citibank in the 70s. We bought risky stocks. We did venture equities. When we made money in ERISA, it reduced our obligation to fund it. So I always say is heads you win, heads you win, tails you win, heads you win, tail the employee loses. Because before ERISA, companies would gamble the employee's pension fund, and if they doubled it, that's less money they had to put in. Well, let me move off ERISA. But ERISA came up with the defined benefit plans of 1974. It codified them. It made them record them in accounting, and that's when they realized they were actually broke and switched to defined contribution. ERISA actually covered a lot of health care, but no one cared about it then because health care wasn't the big expense it is now. In fact, when we did ERISA, the entire health care expenditures in America were about 6% of GDP, and they're 18% now. The major amendment to ERISA in 74 was COBRA, which did a lot of things, but COBRA basically said that when you fire an employee, you got to let him stay in the group plan from 18 to 36 months, 36 for spouse, 18 for him, and it really was coverage between jobs. And keep in mind, because we're talking about small employers here, COBRA does not apply to companies in less than 19 employees. HIPAA. The fifth, of course, was the 1996 HIPAA, which actually didn't take effect till 2006. HIPAA, people think the P is privacy or the P is portability. But what HIPAA really did is it said when you have a policy with a company and you get another job, the next employer's got to cover if you do A, B, C, and D within 63 days. Most important for us today, HIPAA said in 1996, all states must have a solution for individuals who, because of medical reasons only, not their income, who medically can't get insurance. They're called uninsurables. They may be worth hundreds of millions of dollars, but if they apply for a policy and they're rejected, you, the states, must have a solution for them. Then they called it a state risk pool, and all states must mandate that coverage from 2006 on. And of course, I've been somewhat of a pariah because I've had governors call me up screaming at me. Professor Pilzer, we did not enjoy you coming into our state and telling all our agents and employers that every uninsured person can guaranteed get issued from the state. We're already going broke, and you cost us $100 million. And I once said to a governor, you know, about 130 years ago, a bunch of states didn't like some laws of President Lincoln. They seceded. It didn't work. There was a big war. They lost. Same thing to you. You're a part of the United States. Cover your uninsurables. Figure it out. It's a federal law. So HIPAA now has taken effect. And since the last 5 years or 6 years, since 2006, the state risk pools, the guaranteed coverage, have dramatically improved by the states, although they're all about to go out of business because of ACA. Number items number 3 through 5. Notice this. Number 3, ERISA, COBRA, HIPAA, all have one major assumption that no one dealt with. They assume that when you lose a job before age 65, when you go on Medicaid, what are you going to get within 63 days? Another job. I want to say that again. All of our healthcare solutions are based on the concept that when you lose a job, you will get another job. Both jobs will have group plans. And when you turn 65, you get Medicare because you may not get another job. And of course, as most of us know, you lose a job at age 50 today, I'm 58, you're probably not going to get another job. You probably type 50 words a minute instead of 120, and your productivity level is like a fraction of what a 30-year-old is today. And I'm not saying this disparaging, I'm saying it tough-wise and accurately. So HIPAA, ERISA, COBRA really don't work and don't apply to people who lose a job at 40, 50, 60 and don't have another job right away. Next, now comes the Affordable Care Act. And the Affordable Care Act we're going to cover. We're going to say what it is and what's changed it. And let me do a little time check. Are we doing good?
We're at 11:37, so you got 23 minutes.
Okay, good. So Affordable Care Act was what President Obama ran on. I'm going to reform health care. He had the advantage back then of course, a full Democratic House and a Democratic Senate. And they did what we would call a one-party bill. And I'm not trying to sound partisan here. I don't even know what party I belong to. I worked with Bill Clinton on Republicans for NAFTA. in my last official job in Washington. And of course, I served 2 Republican presidents before then. I'm an American. I'm real proud of it. I apologize now if I sound political. I don't mean to be. This is not a political discussion. This is what happened. So ACA was passed when one-party Democrats had Senate, House, and presidential control, and it created effectively a generic national health insurance. Because what it did was it mandated the benefits for all policies. It said all policy has to have this, and this, and this, and this, and no deductible psychiatric care because somebody who needs psychiatric care should get it. And when it went on, is ACA effectively set the bar so high for what's considered health insurance that everyone's going to meet the minimum. Number 2, it mandated the purchase. It said, you're an American, as you walk down the street, we're going to make a law that you have to buy this, whether you want it or not. And that, of course, is the main argument we're going to cover, that the Supreme Court is literally discussing this day and could rule tonight, but has to rule by June 25th. We'll cover that in more detail. ACA mandated guaranteed issue. You couldn't mandate you have to buy it if you couldn't get it. So it said guaranteed issue. Children in 2010 are all guaranteed issue. Any child applying for a policy, regardless of ill health, gets the policy at no increase in premium. 2, it mandated guaranteed issue from a federal risk pool for some adults. And we have quite an extensive staff here working with employers to get their employees into those federal risk pools. Most important, by 2014, it said everybody's guaranteed issue, no exceptions. If you apply, you get a policy, you pay the same rate regardless of your health. And that was the big item that ACA is known for, which ties in effect, as you'll see in a minute, to the concept of the mandate. And very important, ACA mandated a major expansion of Medicaid and eligibility. Remember I said Medicaid had 45 million people covered? It expands it to something like 60 to 80 million. Because it said somebody earning 30 grand, 40 grand, 60,000 in New York is really poor. And if you're poor, we're going to cover you with Medicaid. And that's a very key item because the federal government doesn't fund Medicaid. It funds, on average, about 60% of the cost. The states fund 40%. In some states, the federal government funds 10%. In some states, 90%, depending how poor the state is. Last I looked, Alabama had 90% funding of Medicaid by the federal government. But here's the key. The challenge is become by many states. So while you as a health benefits professional on this call are focused mainly on the mandate and the guaranteed issue and what the Supreme Court would do, the bigger issue if you were the governor of any of these states is you can't pass a law, federal government, taking the Medicaid rolls from 45 million to 80 million. I'm in California. Give me 8 more million people I got to cover with Medicaid policies which don't allow for generic drugs. They get all name brand drugs, unlimited. They get heart transplants, unlimited, and you not give me the money for it. And that's one of the big issues for the state. And frankly, that issue of Medicaid eligibility is bigger for a governor. And I want to give you that perspective because you need to understand the political environment as we start to discuss what's going to happen in the Supreme Court the next week. So the Affordable Care Act of 2010, and I've covered this in a previous webinar, so I'm going to go very quickly and assume if this is of interest, you already know it. It mandated the benefit for all policies from immediately no lifetime maximums, preventative care, and certain benefits must be in the policy. It basically said if you're over 50 employees, we're going to give you a penalty. We're going to tax you if you don't offer health insurance to your employees. If you're under 50 employees, no penalty. And you need to focus on what happened here. The original health care reform bills that I was back and forth to Washington on in 2009, 2010, the original bills said that, look at the bottom here, health insurance costs about $6,000 a year per person. Let's tax a person $10,000 or tax their employer if they don't buy health insurance. And since employers are smart, they won't pay a $10,000 penalty per employee or $40,000 for a family of 4. They'll pay the $6,000 a year for health insurance. Woo-hoo. The Senate, on the other hand, wanted a penalty as low as $750 because the $750, the Senate, who has to deal with much longer-term issues, said, you know, employment's bigger than health care. And if we put in a $10,000 employer penalty versus a $6,000 employer cost per person and dependent, there are many companies in the U.S. that have already 100,000 employees in the U.S. and 100,000 in India. Guess where they're going to grow? In India. I think it might have been good for the world, but from a U.S. employer standpoint, it looked devastating. So when it finally passed, when the White House, the House and the Senate had their conference, they lowered the penalty to about $3,000. And it's actually $2,000 max on all employees. See number 2? So in effect, an employer can say, I will cover my single employee for $6,000 a year in insurance, or pay the $3,000 penalty. Oops, did I lose the slide here? No. Pay the $3,000 penalty. And of course, what we've seen from AT&T, from Verizon, these were front-page stories in the Wall Street Journal, they immediately passed memos saying, when this bill takes effect, we are canceling 1 million people off our group plan, and they don't call it a penalty, they call it a contribution to my employees' health care through the federal government, because he gets a subsidy. Most significantly, let's get to this piece right here, is massive subsidies on individual policies. The Affordable Care Act said that an individual buying a policy will pay a premium based on his salary. So let's just examine the $40,000. A $40,000 income earner will get what I call Goldman Sachs health insurance, meaning the best possible policy any of us ever know, no lifetime maximum, very low deductibles, no deductibles at all, and psychiatric, preventative care, and lots of good stuff. And that employee, if he earns 40 grand, and here's what's very interesting. In the bill, it says what he pays. Normally, bills are written like, the employee will pay a reasonable amount as determined by the White House or the President or the Secretary of Health Care. Wrong. In this case, the bill says an employee earning 40 grand will pay $2,178 premium for his entire family. If his family costs $6,000 a year, it's now up to $8,000 per person. Expected total cost of $24,000. Look at this. The employee gets $24,000 worth of health care. It's guaranteed issue, and he pays only $2,178 maximum, and that's set in the bill. They can't raise it and says he should pay more. The government premium subsidy is 21 grand. If he earns 20 grand, he gets 100% subsidy. That's the expansion of Medicaid. If the employee earns 80, he'll pay 9.5% of income, $8,000. But look at this premium subsidy. What are these subsidies going to cost for individuals? Watch this one. Oh, actually, it's coming up in the next slide. I'll go back. Sorry, I lost this. Sorry, excuse me for the slide bouncing around. It'll come up in a second, but it's $800 billion, this cost of these subsidies, and I'll show you in a moment. So in 2012, let me jump ahead here, we've seen already, because the people know what's coming, they're massively increasing employee participation costs, and Walmart's the leader doing this. They're doing this because the federal government has said you can't have deductibles on wellness. There's so many other things you have to cover. You have to cover children without underwriting, and net, employers have already reacted, really limiting benefits. Very sad, because health care reform was passed in 2010 to get us better benefits, but the cost high that the employers are taking every advantage they can to lower benefits, and of course they have to lower employment trumps health care in every situation. Second, of course, which is very good for our business, I feel like an arms dealer right now in 1945. We are being very much pushed towards defined contribution. I've been pushing defined contribution because I think it's better, fairer, long-term, more safe, and better for the employee to manage his own health care with his money. However, defined contribution is now taken off, as evidenced by the sale of Extend Health, as evidenced by companies like Liaison, Bloom. These are some of the competitors that Zane Benefits has spawned, and they're a little different model because they sell insurance. But the point is, defined contribution is the buzzword, and it's being driven by coming guaranteed issue of personal policies and massive increases in group policies today. How the economy is affecting 2012 renewals. What we're really seeing is that it sucks taking a job, an employee will tell you, that doesn't have health benefits. But you know what's worse than that? No job at all. People are very happy in many cases to get reduced benefits, reduced jobs. You see the $150,000 executive saying, this whole year I couldn't get a job at 75 grand and I used to earn 150 next year. Boy, would I like one of those jobs at 75. I certainly should have taken them. Because what we're really seeing is a retooling of our economy. I'm going to take a moment here and tell you what's going on in the economy. I'll try to do this in less than 30 seconds, but hopefully this sheds some light when you're analyzing a company's healthcare plan and helping one of your clients survive. Picture an island with 10 people on it. 10 people work on the island. They live on the island. They each have a wife. It's a traditional island. The men work, kids, the woman raised the family, and every family's got 4 people, 2 kids and a couple. 10 huts. The island makes its entire living by fishing with with fishing lines. They go to the end of the dock, they throw out the fishing line, and each fisherman on the 10-person island barely catches enough fish to keep his family alive. Along one day comes a missionary. Missionary says, hey, I'm stopping by here. I'll give you a gift. Here's a net. What is this? Well, with this new thing called a net, only 2 fishermen, one who rows the boat and one who throws the net out, you too can catch all the fish that 10 people did with lines. 500% increase in productivity. 2 fishermen with a net catch all the fish that 10 people did with lines. The island's got a big problem. What is it? 80% unemployment. Because now two people, different things. I know, says one guy on the island, let's make use of the net illegal. That's what they did in England in 1820 when loons put people spinning jennies and stuff out of work. I know, says someone else, watch the math. I'm a mathematician. Let's tax anyone who uses the net 80% of their fish and give it to the 80% who don't have to work. That's called the United States of America. That's what we did in the 1930s when certain people invented how to use nets. Another guy said, I know, let's tax people 100%. You can use the net, you don't have to use the net, but we're going to take all your income and redistribute it. It's called communism. Half the world, starting with Russia, China, all did that. And of course that didn't work because the people stopped using nets and their economies ground to a halt relative to the United States. And of course, what should they have done? What they should have done in this island is said, hey, you 8 people who don't use the nets, you become a doctor, you become a teacher, you become a roofer, you become a singer. Let's build an economy where each one of you adds to the world, and we'll have 5 times the GDP and enjoy all these new services. And of course, what happened? What happened is, in my example just now, in the past, you, your father, your grandfather got educated for a job. Many of you learned health benefits in college. And that's all you've done all your life because your job changes over decades. That no longer happens. We have next presidential election of 2012. What is the presidential election about? The people with the nets. The people with the nets, there's evidence 13,000, are doing extremely, extremely well. They are making more money than ever before. Household wealth is up to $67 trillion. The people who use the nets, it used to be, they were the white Anglo-Saxon Protestants. Today, in every white Anglo-Saxon Protestant, you have something like the President of the United States has. One brother has a degree from Yale, one brother has a time in jail. Because from Roger Clinton through Neil Bush, we see that educated, successful siblings have often unsuccessful people. We no longer have the racial discrimination we used to have. We have discrimination based on who uses the net and who doesn't. And what we see is the net comes up so fast in every job that you've got to be able to use the new net. And what our election is about is what do we do with the people who either can't use the net, won't use the net, can't learn how to use the net. Whatever the reason is, the effect is the same. Right now, only 55% of ready, able to work, healthy Americans work. That's down from 70%, heading to 20%. I can show you that in a decade, we can have our entire GDP in our economy with 20% of the people working versus 55% today. And the question that we have to decide, starting with this election, is what are we going to do for adults when somebody uses the net and takes away their job? Now, within all that, you see what's happening here. Massive economic pressure has become more important, if you look again at the slide, than health care for employers. Now, how is the federal deficit affecting the Affordable Care Act? And here, I'm going to come up with CLASS in a moment, because CLASS was as important as ACA. Just remember the acronyms. We're going to talk about CLA, SAS, ASS in a moment. But what we're seeing is that the federal deficit is driving Affordable Care Act. Forget about the Supreme Court for a moment. Assume the Affordable Care Act was passed in 2010, being implemented on a 4-year timetable to 2014. Deadlines are being missed. Waivers are being granted. Why? Because as bad as the federal deficit is, no one wants to see it get worse, including our current administration, depending where you come from politically. Unemployment trumps the deficit, which trumps ACA implementation, that last slide. And just the subsidies on individual policies. Remember I said that a guy earning $40,000 a year gets $21,000, this line red subsidy? Just that subsidy on those families alone is $872 billion. Put this in perspective. The entire federal deficit is $1.7 trillion. Just the subsidy on the people under 80 grand but not poor enough for Medicaid increases by $872 billion. What it means, ladies and gentlemen, is the money's not there. ACA was passed without funding. There is no money. And unless we're going to take a deficit from 1.7 trillion to 2.7 or 3 trillion in 1 week come 2014, the money's not there in the government policy. I'm going to take a moment about CLASS because CLASS holds some interesting items. So I know you're here because you were told you'd learn how the Supreme Court might rule and how it's going to affect benefits. But bigger than the Supreme Court ruling is what the deficit's going to do to ACA. And let's take a look at CLASS. Many of you know at long-term care insurance, this was the dream of Teddy Kennedy. Teddy Kennedy said an American who puts money into Social Security should have a basic amount to live on. He got that. Teddy Kennedy said people as they get older live at home and they want to live at home with dignity. Everyone needs long-term care insurance. Think of it. Do you hope you just walk down the street and die at 70, or you get to live at 80, 90, 100 and see your children? Obviously the latter. But as you get to see your grandchildren and great-grandchildren, 70, 80, 90, you're going to need help living at home. No way out. You're going to die, but you're going to need long-term care insurance. What happened? Long-term care insurance people went broke. Remember I said how life expectancy went from 50 to 84 from 1950 to 1980? The life insurance companies got a fortune. But who died on that? The long-term care people, because they counted on you dying at age 50, 60, 70, so you wouldn't need much long-term care at 80. They counted when you had a slip in the tub and needed long-term care, it was for a week and then you died. So excuse me, nobody's dying anymore. And because they're not dying, long-term care companies all went broke. I mean all, except for GE Capital, and GE wisely spun theirs off just recently. So what happened is people paid in for long-term care, they didn't get it. There were 2 bills passed in 2010. In 2010, when health care reform was passed, and I was going from office to office in Congress, there were 2 bills. They passed 24 hours apart. One bill was the Affordable Care Act, but the bill before that, the day before, was CLASS, which is the Community Living Assistance Services and Supports Act, which is basically government-guaranteed long-term care. And this bill, passed in 2010, said that by 2012, the Secretary of Health and Welfare, Secretary Sebelius, will issue a chart. And that chart will say that at age 18, if you pay in, like Social Security or Medicaid or Medicare, you pay in on your payroll. By the time you're 65, you get a certain amount of CLASS, meaning a certain amount of guaranteed long-term care assistance. And you can't go broke. It's guaranteed by the federal government. And what happened? When she came to issue those regulations, Sebelius, this was only last October 2011, she said, the numbers don't work. I don't have the money for it. I run a department here. I have, I don't know what the budget is, probably $50 billion. I can't afford this. So they, very quietly, completely suspended the bill. Here was a bill passed by Congress that said the Secretary will issue the rates for people to pay in and start buying in 2 years. And 2 years later, the Secretary said, no money, bye, and moved on. That will possibly happen to all of healthcare reform, because the major pieces in healthcare reform have costs far over what CLASS does. And CLASS right now, no one seems to care. Though the state should be suing, saying, I was told there'd be a guaranteed federal program for people who want to have long-term care assistance, and there isn't. Moving on from that. What's a private healthcare exchange? I want to cover this because people think healthcare exchange is something, oh, I don't know what this private healthcare exchange is. Tell me, Professor Pilzer, I've been in the business a long time. I don't understand it. And I go, it's no more than you, sir, having a website saying Joe's Insurance and putting carrier A and carrier B, or even 2 policies from the same carrier, and say, this is Joe's Exchange, pick one. It is not some magical policy. It's a euphemism for any place. This could be a web page, could be a meeting in a client's office where you give a guy a choice. And when you give him 10 choices or 30 choices or 50, it's a bigger exchange. And I'm smiling because the word exchange became such a buzzword that when Extend Health, my company I founded and still own very significant stock piece, filed an IPO last January as the new healthcare exchange. That's what the media wrote us up as. I can say this now. One of our customers said, I want to play in the healthcare exchange business, and paid $435 million, all cash, on May 29th to take over the company rather than let it go to the public, because they had to be in the exchange business. And I'm sort of smiling. An exchange is a piece of paper with 2 quotes from a carrier. You guys on the phone probably do that every day. New technology, they say, oh, I just took it back. Let anyone have a private healthcare exchange. But defined contribution is the real buzzword. The exchange is what you go to once you get a defined contribution policy, which means each employee gets an allowance of money to go buy health insurance. So now we get to the United States Supreme Court. The United States Supreme Court is about to rule in 2012 on a bill passed in 2010. I want to give you a little background here. It's pretty amazing. Think of a bill passing that the Supreme Court, from Miranda rights to all these things we think of as the Supreme Court changing life for every American, or at least every policeman with Miranda, all kinds of bills. And the Supreme Court rules on lots of things. In this case, the Congress of the United States, the majority of the House of Representatives, the majority of the Senate, and the President of the United States passed the bill. And the bill has been sued as being unconstitutional by 26 states. For those of you not American, there's only 50 states in America. Normally, one state might sue. Alabama would say, you're hurting my offshore drilling. This federal bill is unconstitutional. And one state wants it repealed, and 49 states like it. Why do 49 like it? Why would Congress, House, Senate, and the President sign a bill that the majority didn't like? The majority had to like health care reform. What's amazing is that 26 states, that means the governor of each state, looked at it and signed it, or had his attorney general, saying we, the state of California, we, the state of Texas, we, the state of Utah, are suing the federal government, saying it's unconstitutional. And I want to explain how unprecedented that is for the federal government to pass a bill by all majority and then have the majority of the states sue. And what they're contesting is several things. They're contesting, of course, the mandate, insurance mandate. They're also contesting the fact that they've got to come up with 20 to 40 percent more. They've got to come up with hundreds of billions of dollars to fund Medicaid. And they were barely making it with Medicaid before. And other things that are being, the Supreme Court between now and June 25th will issue 9 rulings. One of the rulings you may remember is the Arizona immigration law. Is it upheld or not? But the biggest thing, of course, is what are they going to rule on Affordable Care Act? I've analyzed that there are 4 basic alternatives the Supreme Court can do. I'm going to talk now and then jump to questions on the 4 things the Supreme Court will do in the next 10 days. And the reason you need to know all 4 is it's not that easy. It's not like they're going to do one and woo-hoo, it gets implemented. Because as you saw with immigration last week, the President of the United States has a lot of power on how these get implemented. So let's discuss each one. Number 1, the Supreme Court can say, despite the fact that 26 states, not some crazy individual here, 26, the majority of the United States, have sued us to say this bill's unconstitutional, it isn't. Now, they could do that. If they do that, there are 5 Republican justices, and particularly Robertson Kennedy, who voted with the Republican Party when it came to decide who was president of the United States. Remember that? The Supreme Court ruled and they vote on party lines. One of them would have to cross lines. So to uphold the entire Affordable Care Act, they would have to cross party. One of them would cross over from a Republican to a side with the president. And remember, he can't get appointed to the Supreme Court. He already is on the Supreme Court. There's no extra job for these guys. And then the entire election is about ACA. The entire election will be Romney saying, elect me and we'll repeal Affordable Care Act before 2014, because I'll take office in January 2013. And Obama will say, elect me before that crazy man repeals Affordable Care Act. It's going to come down to a simple election issue. And for all of us, it's going to be very difficult. You think it's been rough now, waiting for the Supreme Court decision to make decisions. Think what's going to happen here if all your client or your employees are bombarded with every day is Romney versus Obama and their single issue is the Affordable Care Act. I don't expect one to happen, but I wanted to mention that a lot of people expect one to happen, including the House, the Senate, and the President of the United States when he signed the bill. He knew there were other people that were going to object to it. Number two, and this is all for those of you who follow con law, and I find constitutional law just so fascinating, is they could invalidate part of a bill. They've never done this before. And when a bill is passed, it goes to the Supreme Court. They say the bill is constitutional or the bill is not constitutional. They don't say this line in the bill is not constitutional, but I'm going to uphold the rest. They always go binary in the past. Why do they go binary? Because they say, hey, Congress, you passed a 10-point bill. We think point 7 is unconstitutional. Go back and fix it. And the ruling is that the same Congress, Republicans and Democrats that passed the bill, they liked it, they wouldn't have passed it, will go back and fix Clause 7 and figure it out. But in this case, it's as if we're in some sci-fi world where everybody's dead. The Congress of the United States of 2010, which was 100% majority, Democrat, Senate, and House, doesn't exist anymore. You can't go back to those people. They lost their offices in 2012. We now have a bipartisan Congress with the Republicans controlling the House and the Democrats controlling the Senate. And what that means is both sides, the Supreme Court could invalidate part of it even though they've never done it before. And we don't know if they can or will. Now, most parties do agree on this, though. Both the Republicans and Democrats say that if you're going to throw out the insurance mandate, that everyone has to buy insurance, you're going to need to also invalidate guaranteed issue. Because if think about what would happen. None of us on this phone call would buy insurance. We would literally wait till we had the heart attack, or maybe a day before, and in the ambulance call our wives and say, hey, get on the web and buy health insurance. I'll be at the hospital in 10 minutes. Healthy people would all hop out if it's guaranteed issue. So you see how the insurance mandate goes with guaranteed issue. However, the Supreme Court are not economists, they're lawyers. They can throw out the insurance mandate saying it's unconstitutional. They can't throw out guaranteed issue saying it's unconstitutional. So it's a fascinating debate if they decide to invalidate part of ACA and leave part in place. And I would love to tell you I had some insights here. This is totally unprecedented. We have never had a bill go to the Supreme Court where they go through it line by line and say, this is constitutional, this isn't. They normally just say, bill doesn't work, go fix it. In this case, the people aren't around to fix it. Third alternative. Oops. The third alternative is the Supreme Court could reject the entire Affordable Care Act. That is frankly what the 51% bet is on today, is that Congress passes a bill, and they pass a bill with many, many provisions, and they're all fought over. And here the Supreme Court would be saying, you passed the bill, let's make it arguments that there happen to be hundreds of provisions, but pretend there's 10. You passed the bill, Mr. Supreme Court, with Congress with 10 provisions. We know that you wouldn't have passed number 3 without number 4, without number 5. So we will reject the entire bill as we have since the Supreme Court was founded over 230 years ago. So in effect, number 3 is that they will just reject ACA even if they only disagree with one provision. Most of the money is on number 3, but there are people claiming number 1 that they'll just approve the whole thing. And here's a really fascinating one. Supreme Court postponed the ruling until 2015. They shouldn't be ruling on this. In the past, you have to have a plaintiff. The states are complaining, saying that in 2015 I have to pay for Medicaid. That doesn't work. You have to wait till 2015, tell the federal government you won't write the check. The federal government says sue you, saying, states, pay me that money for Medicaid or give this person Medicaid. And then on January 1, 2015, you're allowed to file suit to the Supreme Court. And we'll hear it sometime in late 2015. In effect, that's where we are. While the Supreme Court has already said they're going to look at this and rule, the first argument they heard on March 1st was this argument number 4. So that the lawyers come forward and say, and these are mainly Democratic lawyers who want the bill to stay, is, hey, these people have no standing to complain because no one's been injured yet. The bill hasn't taken effect till 2014 when the mandate kicks in. So they actually could do this. And if they were political, meaning if they had some other agenda, if they were trying to get to be appointed to the Supreme Court or something, this would be the logical answer. Delay this thing a year or two to see who's president. So with that, I've covered, oops, we'll back up. We've covered that the current law on the Affordable Care Act and its 2012 to 2014 implementation. We also should point out, number 2, regardless of what the Supreme Court rules in the next few days, key components are going to stay. Already, United Healthcare, Humana, the major carriers, the Blues, have said no lifetime limits on policies, children guaranteed issue, children under 26 years old can stay on the parents' group plan. I'm laughing about that. If you saw the news last week, the healthcare carriers said, we're going to go with what's right, and if a person's 23 years old and still in college and wants to be in his parent, or even not in college and wants to be in his parents' group plan, we'll let him stay. Aren't we nice? Look what they're doing. A 23-year-old can buy an individual policy for $60 a month, or he can pay $600 a month in his parents' group plan. Of course they want them to be guaranteed issue in the group plan because they don't want people like you telling them that anybody over 21 to 26 or even 18 to 26 should buy their own personal policy if they're healthy. Next item. So already number 2, key components of healthcare are here to stay in the private market even if the bill is taken away. Number 3, the federal deficit will drive government decision-making 2012 to 2014. I go to this with every client. They ask about all kinds of issues from subsidies for offshore oil. Remember, I'm an economist who works mainly with governments. And I say in the United States and other democracies, the budget deficit is king. It trumps everything. Because no matter what someone promises, no matter what gets elected, they got to be able to write the check and it can't bounce. And the money, balancing that budget on a monthly basis is so critical that the federal deficit in the U.S. and every other country will drive us for the next 3 to 5 years. And it's happening in Greece and it's happening everywhere. 4, we've seen some fascinating things with immigration on President Obama. Sorry to say this, but he did what I call morally was the right thing. Whether it was legally right or fair or unfair, I'm not going to comment on. But I'll tell you that the president has enormous power to go around Congress. And President Obama did that very successfully with immigration. And I'm expecting we're going to see a lot of that on health care. You could have the same kind of meeting and issue this executive offer, this executive order, et cetera, to keep health care funded. And there are many things in this bill that if the Supreme Court turns it down, technically could stop Medicaid and Medicare from paying doctors. And I expect the president is working on these things now. So expect a lot of executive orders which are like wild cards because whoever heard of the president doing what he just did in immigration? He said, I can't change the law. These people are illegal and must be sent back to Mexico or wherever they come from. But I can tell my policemen, don't enforce it. You got other things more important. And that's effectively what he did. Number 5, massive shifts continuing to defined contribution programs. Our business is so good here at Zane Benefits, we call ACA the Zane Benefits Relief Act. I'm embarrassed saying that at Zane because we didn't need financial relief, but we've seen the world rapidly shift to the full defined contribution plans. We're very proud that we make the software to let all of you do that, and we hope that we continue our long relationship with you, converting people to what's really morally right. Give people their own money to spend on their own health care. End of story. And of course, we're seeing a lot of branded healthcare exchanges, as I already covered. With that, I've tried to give you a summary of a lot of pieces. I hope we have some good questions, Rick.
I think everyone's been paying attention. We've kept up the questions typing, so I'll let you go about 8 minutes over, just so you know.
Oh.
So if you have about 15 minutes with us still. If you'd like to stay on for questions, please type the question.
Okay. If there are any questions on any piece of this or anything specific, then I'm good. I'm glad my people have been individually answering questions as they came in on.
Yeah, and that was a great presentation. Thank you. And we'll stay on the line if you'd like to jump off. I know we went over. Sorry for that, but I thought the information was great and didn't want to interrupt you. But type in the question, and we will ask Paul Pilzer for the next 10, 15 minutes, assuming there are questions. I'm getting a lot of raised hands. If you have a question, please type it into the question box. This is a question. I like this one. In your opinion, what is the most likely of the 4 scenarios that the Supreme Court ruling will rule?
In my opinion?
Yeah, in your opinion, what's the most likely of the 4?
Boy, it's such a guess. I'm going to duck the question and then, no, I'm going to duck it because if I go back here, let's go back. They're either going to reject the entire ACA number 3, or right now I think they're going to do number 1, which was, sorry, I'm going back there on the slides. They're going to uphold it all. So they're going to uphold the bill, crossing party lines, or reject it. As I say it out loud, if I had to put money, I wouldn't bet on this because I have no basis for saying it, it would be number 3. They're going to reject the whole bill and send it back to Congress, which is what traditionally the Supreme Court does, and Congress in its current state doesn't stand any chance of passing it. And then we got a real free-for-all with presidential orders for what happens to keep health care, Medicaid, Medicare funded, because there were several. We're going to need some emergency legislation just to keep the business running of health care.
Makes sense. Find another good one. You mentioned private health exchanges were basically already existing before the term private health exchanges. Do you believe that term will stay around, and will private health exchanges exist if the state health insurance exchanges come in 2014?
Absolutely. Private exchanges will exist. The state exchanges may exist, and I say that because I haven't seen the work being done by the states on a proper level to open their business. And historically, the state exchanges, we have one in Utah that's a dismal failure despite what kind of press releases it puts out. And I just have not any faith in government-run exchanges. Keep in mind, my long-term view of healthcare is that eventually the U.S. catches up with the rest of the developed world like Japan, where we offer guaranteed, federally paid for basic health care, and everyone gets that as a citizen. Then additional health care, private rooms, special operations, MRIs, are all paid for with private insurance, and those will exist on private exchanges. And the exchange is nothing more than a good broker, agent, employer putting together a place that people can choose what basically fits them best, just like you choose it for your auto insurance intelligently or your homeowner's insurance.
How does a small employer transition from group health insurance to individual coverage with catastrophic employees on claim?
That, in effect, is a great question, and that's frankly what we've been doing the last, I guess it's, 2012 we started, 2002 we started aggressively for 11 years. And we're just a software provider. You have to work with a good agent or somewhere to get the policies, but basically they go to each employer and say, we were paying $150,000, which works out to $4,000 a person for this employee group. We don't want to make any money on it. We're the employer. We're going to give you that $150 in cash. Each of you are going to now have to choose policies, and here are one of multiple solutions. Here's my agent. Here's a website. Here's where you can buy individual policies, and we will assist with paying the premium. We're going to give special assistance, and we've hired another counselor who you're not going to pay for to help get you into the state risk pool or the federal risk pool or whatever you need to get everyone covered till 2014. I believe that everybody can get coverage if you put all the work, the hard work involved. And it's unfortunate that the states aren't compensating agents and brokers for putting people into state risk pools, but you need to explain that to an employer if you're an agent and broker and put the time in with them. So employers, we've done it. Frankly, we've done so much of it. There's a good story on the front page of USA Today that told through step-by-step how we converted a 120-person company from a group plan to individual, we being the software provider, but involved agents, United Healthcare, different players to get everybody covered. You can't leave anybody to the wolves, especially if they've got a medical issue and they're part of it.
Perfect. I've got a couple great questions. Before, I see one common question, and that is, will we get a copy of this presentation, and can we review a recording later? And the answer to those questions is absolutely yes. So look for an email from a Zane Benefits representative with all that information. We also will be putting out a white paper that covers in more detail the content of the presentation in the next week or two. So it's going to be called The History and Future of Small Business Health Insurance. So hopefully that addresses a lot of questions. One question that I really like, Castlight Health, or Castlight, just got, I think, more than $100 million in funding to scale their medical transparency platform for employers and health plans. Do you see that with a defined contribution? Yeah, so the question is, how do you see that integrating from a defined contribution standpoint?
I think we really got to get back to what defined contribution is. It's a buzzword for an employer giving employees a fixed allowance based on their class of employment. You give a fixed amount to managers, probably usually a lesser amount to lesser employees. You might, if you're in the Domino's pizza business, as our client Domino's does, they give more money to drivers because drivers are harder to recruit and have more medical issues from sitting all day. And what happens, of course, is you give someone money and they go and choose it. Now, the providers just lining up to do this because the providers, particularly the hospitals, have basically said, this is what it costs, and we just charge you ad infinitum. I'm amazed how much innovation I've seen in the last 12 months in the hospital market, part of it being forced on by employers, where they're basically saying one price fits all. You come here, we don't know what's going to happen when we open you up and we do this operation, but this procedure, including the rooms, the food, everything is $8,000, $12,000, $18,000. And what we're seeing is the providers are finally getting smart because they know that the individual customer now is getting smart. And under defined contribution, everybody cares about health care costs, and everyone's going to shop. So
let me ask you another way. So, how important do you think medical transparency providers play in the future of health care?
Huge amounts. And we need legislation, serious legislation, that guarantees medical transparency. I've seen every state group move towards medical transparency, and the doctors and providers fought it. We have to have transparency of cost. My attitude is you provide tax-deductible services. You're part of the federal government. You should be forced by federal law to disclose not individual patient information, but all outcomes and pricing of your customers or your patients.
In your opinion, what's the leading private health exchange on the market today?
I can't say that. I can say Extend Health had an amazing offering for tires. I think it was the leading, which is why it sold for so much money last week. And the leading private exchange, I'll tell you, it's definitely a Zane Benefits client. It's someone using Zane HRA to fund it. Remember, we only charge $6 to $12 a month per employee. And someone using our software, but they're really, let's put it this way, there's about 2,100, I think, different people using our exchange software. So it's one of the 2,100 that are Zane Benefits clients. I do believe that. And at least 5 or 6 come to mind that could be the, quote, best or biggest or best service.
Or it probably depends on the employer and employee needs.
Yeah, the reason we have 2,100, not one, is that every employer has different needs, every state has different needs.
Got it. When will there be another webinar for after the SCOTUS ruling?
Yeah, as soon as we have the ACA ruling and the dust settles, I have to do 2 things. One is I have to rewrite the new health insurance solution, which I've been telling my publisher for years it's just not worth doing since 2010 when I don't even know what direction it's going to take. And the information, and a book takes almost 6 months to years, you may know, to get out. But after the Supreme Court decision is together, I learn a lot assembling these things. and we'll do that as soon as possible once the ruling comes out of the Supreme Court and the dust settles, hopefully within 90 days of presidential rulings, emergency legislation needed to keep Medicaid and Medicare funded, and other things that may come out of an ACA ruling, assuming they throw out ACA.
If the ACA is rejected, what are the best options for otherwise healthy people that have declined them from private health insurance in the past and who don't have group health insurance available?
Well, if the ACA is rejected, the best options would have been the federal risk pool, and I can't tell whether that will stand or not stand without ACA. That's ready to do.
That's decent. And then, what are the state pools really a reasonable option?
Absolutely, the state pools are definitely a good option. You have to do the homework for getting into them, and
they're typically more expensive.
They're definitely more expensive, but they're the bargain of a lifetime. And you walk in there saying, I have cancer, I have hemophilia, I need $10,000 a month. Oh, you're going to charge me $800 a month to get my $10,000 a month? That's terrible. Private carrier would only charge $300 if I was healthy. Realize what they are. They're mandated by the federal government, and the states have to do them. And if more people went to the state government instead of group policies, we'd have better state-insured policies, and we'd have better people suing the state saying you're not complying with HIPAA of '96 that says you've got to give me a decent policy coverage.
I'd also say that the value of PRAs and HRAs for an individual who has a spouse that's working or they're working that has to go to state coverage is really important because it could effectively half the cost of the personal policy on an after-tax basis.
Absolutely. I'm embarrassed talking to you from Utah. Utah is the only state where they've tried to limit federal laws on POP plans from covering our PRA or our HRAs from going into state risk coverage. But all the other states that we know of offer decent state risk coverage. Remember, it's the same hospitals. In fact, state risk pools are almost across the board administered by the Blue of that state. So it's the same Blue Cross insurance, the same provider network, and it's typically only for one person in the family. If a 5-person family, one goes on state risk, pays $800, the others pay $100 or less for an individual policy on who are healthy. And if everybody did what they should do, which is buy health insurance at 18 to 21 on an individual policy, there'd be no state risk pool. Because, if you think about it, you'll get sick when you start working in your 20s, 30s, 40s, 50s, and if you had an individual policy, the carriers would be eating that cost, not the state.
This is a good question. If you could wave a magic wand and fix all of health insurance in the U.S., where would you start and what would you do?
Can I say his name? Whoever that is. Timothy Kane. That's a great question because I'm already there. If I could wave a magic wand and fix it, I would place the following law. It's illegal for any government employee or government legislator to get something his constituents doesn't get. I'm going to say it again. If his constituents don't get free universal health care, guess what? The senator or the congressman couldn't. Can you picture these guys have wives and kids and grandmas just like us? Do you know how fast they'd fix it? Do you know how much better Medicare would? It's the same problem with schools. People ask me about schools. How would you fix all the problems in schools, Professor Pills? I go, that's easy. Make private school a felony. If the 5 million people in private school right now, 5 million kids in private school paying tuition and taxes were not allowed to go to private school, they would have to go to public school. And then after go to public school, we'd all have great public schools because their kids would fix it. And we could mandate it a different way. You could say you can go to private school, but you got to pay every dollar in tuition double to your local public school or some number. Same thing with health care. If congressmen and senators, and I call them sleazebags, almost every state legislative group, including the state of Utah where I'm speaking to you, those sleazebags, and I mean it accurately, I'm not defaming them, I'm telling the truth, get lifetime free health care for serving in the state legislature for them and their families. And the citizens of Utah and the other 49 states don't. If we would just pay attention and only elect congressmen and senators and state legislators on the grounds that they won't accept health care until their constituents get it or they get it at the same price, they'd be part of the problem and they'd fix it. Where I live in Park City, I used to see my governor, John Huntsman, who ran for president, driving on I-80, leaving Park City, right around my house, and drive to his house after his dinner with his parents on Sunday night. And I said, God bless him. Here he is driving his motorcycle or in the back of a limo, or maybe he's doing work in the car, but he's on the same highway, Interstate 80, that I drive on, and Interstate 80 has a problem with snowfall. He calls up and gets it fixed, and I benefit from him riding on the same highway. And if he rode on the same health insurance highway as I do, we'd have a lot better health insurance. But that's what we all got to work for, not electing people to get benefits we don't get ourselves.
How do we go about that? Just it's all about electing people.
It's all about being honest and open and tell the voters it's such a simple thing. But I've been saying this for 20 years, and it hasn't happened yet.
Find one more.
Rick is looking at the last question. Well, these are great questions, but Rick, I think
you see one that you like.
Short answer. Pre-existing. Boy, you guys are all terrific. I'm very pleased. Yeah, is there a simple way to explain the defined contribution program to employers who can easily understand it? From Curtis Bentley. Yeah, real simple. Your employee has defined a contribution. That's defined contribution. That's equal to what he was paying the group carrier we used to have, or roughly equal, or you're going to say it. Your employer has defined a contribution of tax-free amount towards your health care. I'm here to help you get good health insurance or health care, and your employer is going to pay X dollars tax-free. And you can fund your money, your difference, if you want to spend more than that in cash, or you can fund it through pre-tax payroll.
In my experience, and this is Rick, I've found analogies to be work. Whenever you're talking about something new, just relate it to something that people are used to. So really defined contribution health plans are like a business expense account for healthcare. The employees buy their own health insurance, and they get reimbursed by their employer up to the amount that they're paying. Another analogy is it's like a 401k. The employer is making available a defined contribution. You get to choose what policy you buy, just like you get to choose what investments you would make in a 401k. And as the broker explanation would be, I'm here to help you pick the right policy for you, since you're not a health insurance expert. Well, great questions. I really appreciate the feedback. If you have any further feedback that's positive or negative, please email webinars@zanebenefits.com. You can also email webinars@zanebenefits.com. We will be putting an email out in the next couple of days with a copy of this presentation, a link to the recording, and as soon as the Supreme Court rules on healthcare reform, we will be putting together another webinar as a follow-up to this webinar to discuss which one of the four options we are going to have to deal with. So appreciate everyone's time. Professor Pilzer, thanks for your time. I really appreciate it. I'm sure everyone else does. And look forward to working with everyone on the phone and seeing them on future webinars. Thank you.
RightOpt, a private health insurance exchange from hire through retire. We know it's important for you to offer a benefit program that engages your employees, fits your culture, and drives efficiencies into healthcare delivery. That's why we created RightOpt, a private health insurance exchange solution for your entire workforce, from the point of hire until after they retire. Coverage is available for full-time employees, part-time employees, pre-65 retirees, and Medicare retirees. Instead of focusing solely on health insurance, our model considers each member's overall well-being. Members choose their preferred plan options at enrollment, use those options effectively throughout the year, and work to improve or maintain their health risks over time. With RightOpt, both you and your members will benefit from immediate and longer-term cost-saving strategies. Eligible active employees have access to standardized group health plans through our regionally aligned preferred partner strategy. Regardless of where your members reside, benefit plans are the same. And for those participants accessing the individual market, our licensed call center representatives will help them navigate options through the public marketplace, Medicaid, or Medicare to help them make the right decisions for their situations. Of course, savings are ongoing because supporting resources are available to help members make more informed decisions through a personalized experience. Our single access point portal aggregates important messages, tools, resources, personal health information, and incentive award opportunities, and encourages members to take advantage of available programs. And print communications keep members informed throughout the year. Overall, this holistic approach improves the member experience and encourages a more informed and engaged consumer. RightOpt, the right choice for the health of your business and your members.